This is Alan Bush with ADMIS. In the stock index futures, we did see some pressure yesterday afternoon after the Fed statement was a little more hawkish than most analysts had anticipated. Also, we did see a little follow-through weakness this morning for the same reason. However, we feel that futures are likely to recover and trade higher on the day. For one thing, we did have the GDP report coming in stronger than expected, up 3.5%. The guess was up 3%. But also we did have some of the other aspects, other subgroupings in the GDP report that showed inflation is still under control, meaning that there still is room for the Fed to keep the low interest rate environment. And we feel that this is the dominant influence that will continue to support stock index futures. So even though indices are a bit lower, I think we can see a recovery. I think we can see futures trading higher on the day. Over in the currencies, the dollar index very quickly advancing with the Fed statement yesterday, as we said, a bit on the hawkish side, some follow-through gains today. But in keeping with our belief that interest rates are converging as far as central bank policies around the world, the gains that we're seeing in the dollar, we feel will probably not follow through today. And I think from current levels, I think we will probably see some pressure developing. So look for breakouts in both directions in all of the major currencies not to follow through. So this is probably a selling opportunity for the US dollar up at these higher levels. Also a little pressure coming into the euro currency after 5 regions in Germany showing weaker than expected inflation numbers. The pound lower with UK house prices showing a smaller than anticipated price increase. Over in the interest rate markets, pressure yesterday with the Fed statement, as we mentioned, a bit on the hawkish side, but very good gains today as traders focus not on the GDP report itself, which is bearish, but on some of the other aspects of that report showing weak inflation numbers. So the bonds as much as a half higher or more than a half higher, suggesting that futures are, I think, focusing more on the deflationary aspects that we continue to have, not just here, but also globally. And that is likely to keep the Fed from raising interest rates anytime soon, in spite of the statement from yesterday. So continue to trade treasuries from the long side. We have the next major support in the 30-year bonds coming in around the 140 area. I think that would be an excellent area to initiate long positions in the December 30-year bonds. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
Probably about